Welcome to the very first episode of ETF of the Week. In this series, we're diving into the most exciting ETFs on the market to help you discover new investment opportunities, whether you're a seasoned investor or just starting out. Each week, we'll break down one standout ETF, giving you all the insights you need to make informed decisions. This week, we're kicking things off with a heavy hitter, SPYG, the SPDR Portfolio S&P 500 Growth ETF. Why SPYG? Because it gives you access to some of the fastest growing companies in the S&P 500, all at one of the lowest costs in the market. Stay tuned to learn why this ETF could be the perfect addition to your portfolio. Alright, the SPDR Portfolio S&P 500 Growth ETF, or SPYG, is a growth-focused ETF that offers exposure to large-cap US equities. It's managed by State Street Global Advisors, and this fund tracks the S&P 500 Growth Index, which is designed to include companies with high earnings growth and strong price momentum. SPYG is an excellent option for investors looking to target innovative, high-growth companies within the S&P 500 while benefiting from the reliability of a well-established provider. SPYG has an ultra-low 0.04% expense ratio, making it one of the most cost-effective growth ETFs on the market. It also has $36 billion in assets under management and has returned a one-year return of approximately 35%. The dividend yield is pretty modest at 0.58%, as growth stocks typically reinvest earnings rather than pay high dividends. Let's compare SPYG and SPY. Both funds focus on large-cap US companies, but they have different investment approaches. SPYG zeroes in on growth-oriented stocks within the S&P 500, while SPY represents the full spectrum of the S&P 500, blending growth and value stock. SPYG has a total of 208 holdings, which is less than half of SPY's 500. This focused approach results in more weight being placed on high-growth companies. For example, SPYG's largest holding is Nvidia, which accounts for around 13.28% of the portfolio, a far higher allocation than SPY's 6.96%. Similarly, Microsoft and Apple take up 6.35% and 5.72% in SPYG versus SPY's slightly higher weights of 6.4% and 6.52%, respectively. Other notable names in SPYG include Tesla, Amazon, and Meta platforms, each holding larger relative positions than in SPY. Sector-wise, SPYG tilts heavily towards technology, which reflects the growth-driven nature of the ETF, while SPY's broader allocation includes more exposure to value-oriented sectors like financials and industrials. This concentrated tech focus in SPYG underscores its high growth potential, but also makes it more sensitive to sector performance. This is a good segue into the risks of SPYG. SPYG offers exciting growth potential, but it's not without risks. First, growth stocks can be highly volatile, especially during market downturns, making SPYG more susceptible to price swings. Additionally, the ETF has a heavy concentration in technology and consumer discretionary sectors, which means underperformance in these areas could significantly impact returns. Lastly, growth stocks tend to be more sensitive to economic changes such as rising interest rates or slowing growth, which could weigh on the ETF's performance. Overall, SPYG is a cost-effective way to access some of the fastest growing companies in the S&P 500. While it offers high potential returns, investors should be mindful of the market volatility and sector concentration. It's perfect for long-term growth investors looking for broad exposure to US growth stocks at a low cost. Remember to always do your own research before investing. If you found this helpful, like this video and subscribe for more ETF breakdowns every single week.